Hi everyone. So we've got our Q&A again today. So we've got a couple of questions that have come in, but I'm probably going to focus mainly on the first one. And the first question that we've had, which I'll just show here, is how do markets react to longer-term recession or even depression? And really, first thing I wanted to start off with was what actually is a recession and what actually is a depression. So a recession is when the economy shrinks for 2 quarters or more. And what that means is a quarter, as we all know, is 3 months. So if the economy shrinks by at least 6 months, that's the technical definition of a recession. A depression is much more severe. And a depression is essentially, think of a depression as 2 or more recessions together without any recovery whatsoever. And so a depression essentially lasts at least a year, but more often than not, a depression lasts for quite a few years. To put things into perspective, because I know there's a lot of talk about are we going into recession or are we going into depression? In 166 years, there's been 33 recessions and 1 depression. So the idea of that we're going into a depression is a little bit harder to believe than a recession. It could quite well be that we're in a recession. As I said, a recession essentially means the economy is reducing by 2 quarters or 6 months. So in terms of how do markets react to recessions or even depressions, this is where we sort of get into how markets react versus the business cycle. So if we think about the business cycle first, a business cycle, of course, is we have ups and downs, just like the market. So when the economy or the business cycle is going well, of course, markets are quite positive, prices are high, and everything's looking fantastic. As soon as we start to see the economy going down, then the market will react to that. And so it's important to remember, though, that as an investor, you actually want to behave contrary to the business cycle. So when markets are going well or the business cycle is good, that actually, as an investor, can be the worst time to invest because all of that good news is already factored into market prices. It's actually when the market isn't going that well that it can actually be the best time to invest because stock prices are cheaper. So it can be a little bit contrary. Everyone sort of thinks that it's the best time to invest when things are going well, but that's actually not the case. So in terms of how markets are reacting, and we're actually living through it now. We're not technically in a recession, but we may be if this sort of continues on. So how do markets behave during a recession? And essentially, the 3 main factors are share prices experience wild swings. And we're seeing that at the moment, especially a couple of weeks ago when the stock markets, not just in Australia, but around the world, were actually going up and down 5% in a day. Now, that's not based on anything factual in terms of something that definitely happened in the economy. That's just investors react quickly to any hint of news, whether that's good or bad. And so these wild fluctuations are what we generally experience in a recession, and that actually happened during the global financial crisis as well. And as a result, many investors pull their money out entirely. Still getting used to all the, there we go, back to the question. So one of the things in terms of this how markets react in terms of these wild swings in prices just because of uncertainty, and markets hate uncertainty. As soon as we have a little bit of certainty, then markets start to go a little bit normal because they can see that light at the end of the tunnel and they know which direction things are going. Now, in relation to, there's always people that say, oh, look, I knew what was coming or I could see what was going to happen, so I pulled my money out. And the problem with that sort of reaction is that may be a good thing for a short period of time in terms of weeks, maybe even a month or so. But generally, anyone who sold their portfolio and pulled it completely out of the market has done that based on fear. They've done that based on these wild swings, and that makes them scared, and so they just pull their money out because they can't handle it. but it is that same fear that prevents them from going back into the market. And so even though they may have made a seemingly intelligent short-term decision, when they can't actually invest back into the market, which now, of course, is a pretty good time, even though it may be volatile a little bit longer, they actually end up making a worse decision because they end up more often than not buying back in after the market's already reacted to some positive news. And more often than not, they end up buying back in at a higher price than when they sold, or even if it's the same price. And by the time you take into account maybe some capital gains that they may have had and the costs of buying and selling, they're actually worse off. So it's going through these volatile periods that you really work out what sort of investor you are, and this is where the experience helps. So if you're the sort of investor who's selling with uncertainty, maybe you shouldn't have been investing in the first place, or maybe you weren't invested appropriately. And so the better sort of investors are those that actually buy more, and those investors are those with a lot of experience and know that the market will come back. We just don't know when, or just waiting it out if someone's comfortable with being a long-term investor. And as I've explained to many of sort of my clients over the years, the ultimate goal of investing is to build up an investment portfolio from which you're just living off the income stream. So if you have your safety buffer of cash, and we always recommend that clients have a safety buffer or a certain amount of money sitting in cash, so you've always got access to cash in the event of an emergency. As long as you have that safety buffer, and of course that safety buffer should be more if you're living off your portfolio. If you're still employed and earning a regular income, you can have a smaller safety buffer. Then if you're just living off that income from the portfolio, there is no reason to sell whatsoever, because short-term fluctuations in the value of the portfolio is pretty irrelevant to your day-to-day life. It's really based on that income. Now, of course, we could see a reduction in dividend yields. I mean, we're already seeing very low interest rates anyway. We could sort of see a reduction in dividend income, but to be honest, Australian dividends have actually been relatively high paying for a little while. So the last 2 or 3 years, we've had higher than average dividend yields, and we'll probably see them go a little bit under the average yield, maybe for a short period of time, but then come back up to normal. We don't know when, but that could be over the next 6 months, 12 months, 18 months. And if you're someone who's still building wealth, then how markets are reacting at the moment in terms of a depressed market as well as these volatile periods. To be honest, if you're still buying, let's saying you're putting money into superannuation on a regular basis, or you actually do want to build up an investment portfolio, the longer that the markets are cheaper, the better, because it just means that for a longer period of time, they're on sale and that you can work that to your advantage. In terms of the next question, so in terms of any comments that I have on market segments, in terms of any segments or industries in the market that might find a bit of an uphill battle and that should be avoided. If anyone knows me well, they know that I don't believe in trying to pick stocks or even segments. Let's say, for example, let's look at travel. Now, for sure, in fact, I was talking to clients about this yesterday. In some regards, of course, the number of international visitors is limited to Australia, but it also means Australians aren't travelling as much, and there's more Australian money staying in Australia, and so there's going to be a lot more domestic travel. By the same token, there's going to be a lot of pent-up demand from people who haven't been able to travel, and as soon as people can start travelling again, there's going to be a huge demand around the world, not just leisure travel, but also business travel, to start traveling again, but we don't know when that is. So to try and pick stocks, particularly on what could be relatively short term, we're talking months, we're not talking years here. So to try and pick stocks based on how they might perform over the next few months, from my point of view, is pure speculation, and I wouldn't comment on which particular segment to invest in or which to avoid. That then ties into the next question we received in relation to index funds carry a greater risk than direct share investing, particularly during bear markets or recessions. Given, again, going back to this point about index funds having broad diversification and having exposure to all industries. Again, I go back to, you don't want to avoid any particular industries or segments, particularly given we're talking months, we're not talking years potentially here. But also the benefit of having an index fund is you're taking away that stress and that hassle of feeling like you should be picking a certain stock or a certain industry, but as well as by having the benefit of a diversified index fund with access or exposure to all industries, you're also going to obtain exposure to those industries which you wouldn't have necessarily invested in, but are actually receiving a huge benefit from the current situation. And of course, we're talking about, Netflix or anything in relation to things that people can use at home. Online deliveries are huge. Home gym equipment is huge at the moment. Alcohol is huge at the moment. So these are sort of industries that by investing broadly, you're going to get the benefit of, even if there's some short-term softness in some other industries, such as travel. I really do believe, though, that travel will increase again in terms of a really high demand, because there is so much pent-up demand. And it's interesting to think about as well. For sure, there's been a lot of people that have been adversely affected in relation to the current situation in terms of losing their jobs or shorter working hours. But there's also a lot of people that are still earning their normal regular income and they're saving. So as soon as people are allowed to sort of enter, normal life again and can travel, go to restaurants, bars, cafes, there's this huge pent-up demand, and there's definitely going to be a surge of spending once people are allowed out again, so to speak. And the last question that I'll finish off today, and this is definitely an Australian question: are Australian banks safe? And this is something I've sort of put a comment there with. We're getting a lot of questions about this from various people, and generally not from newer investors. This sort of question is really coming from more experienced investors who've been investing during the global financial crisis. And the one point that I just really wanted to make here is the global financial crisis was that it was a financial crisis, and it was a fundamental problem in the banking system, particularly that came out of the US, but then filtered around the world. Australia less so, though. The four-pillar system that we have in Australia really protected Australia from serious financial consequences compared to the rest of the world during the global financial crisis. But this is what we're going through here with COVID-19 isn't a financial issue necessarily. It's more of a labour issue in terms of people can't working and people not being able to do things. So there is absolutely no issue with Australian banks. And in fact, after the global financial crisis, banking systems around the world actually had to improve their strength and their liquidity to make sure that if there was another crisis, such as the global financial crisis, they were in a much better position to withstand that. The Australian banking system was already very good, partly because of the lack of competition, because of this four-pillar system. But then they also had to strengthen their position, which is, for anyone who might remember, term deposit rates were fantastic after the global financial crisis because banks had to attract a lot of new money to meet these new requirements. And also the bank guarantee actually still does exist, although it's definitely not needed. It's just that it never ended. So I would absolutely say there is no concern whatsoever with Australian banks. They were pretty much it for our questions. In terms of these live Q&As going forward, we're going to keep it in relation to about 15 minutes. I think that's long enough for people to sort of sit at their screens and listen to me talk. But as I mentioned last time, so we will be doing this every Wednesday at 6 o'clock, and would definitely love to get any questions that you would like addressed that we'll sort of go through and address every Wednesday. Thanks for listening and hope to see you soon. Bye-bye.